right, ladies and gents, welcome. Let's have everybody in and we shall get started at 6 o'clock. So about 3 minutes or so. Markets, yeah, not doing an awful lot. We've got the presidential debate this evening, which I don't expect to move the markets in a massive fashion, but you never know. You never know. We'll get started in a moment. Everyone enter, get yourself comfortable. Just reading my absolute hammered version. Coffee stains on it, well thumbed, reminiscence of a stock operator I like to keep around here. You can't see them on bookshelf, can you? Actually, just off camera, but Pitbull's another one. And there's a little quote in here, and it said, "I can't sleep," answered the nervous one. "Why not?" asked the friend. "I'm carrying so much cotton that I can't sleep thinking about it. It's wearing me out. What can I do?" "Sell down to the sleeping point," answered the friend. I know many of you are day traders, or maybe you're kind of sometimes swing traders, but that's good advice, right? You got to be you can't let trading keep you up at night. And if you've got a position that's way too big and you're not sleeping, you're checking the futures in the middle of the night, even if you haven't got a position on, you're checking the markets in the middle of the night, you're getting up. That's not a way to conduct yourself, and it never really pays off. So I thought, yeah, there's always some good little nuggets in this book. Definitely recommend it if you haven't yet. Reminiscences of a stock operator, all about Jesse Livermore. I've talked about as many times, and those of you who have been on this webinar before are like, yes, Mark, you're boring us with your book recommendations. They're the same books, but they're damn good books. They're damn good books. All right, who have we got? Okay, people coming in. Welcome. Markets are down a touch across the board. Just look at my other screen here. We've got DAX down to 30 or so. NASDAQ almost back to flat. Dow down 280. S&P pretty much flat, down a smidgen. 17. Russell down. Looks like it's the weakest of the bunch. DAX didn't have a great day, but a downtrend on the DAX. What have we got across the board? We've got CPI coming up later this week. And of course, for tonight, this evening, we've got the election debate at 2 o'clock UK time. I won't be up watching that. But I will see how the media decide to report on it tomorrow. Let's see what happens. Oh, by the way, before we get started, there is on Pepperstone has got will have an election hub coming up on their website. I'm sure you also have an email about it to kind of keep you up to date with the stuff that's coming at the election. I've got something to show in a moment about that as well. But now's about the time just to start. We've got September, October, November, just come and interview. Just there, it's just going to change things a little bit. I will be doing a webinar at some point to talk about some election trading strategies or potential trading strategies, what to look out for, what not to look out for. Anyway, let's get started. This evening, we have something a little bit different. I do these webinars pretty regularly for Pepperstone or partnership with Pepperstone, and I don't really give new traders much love. And I felt like I should. I felt like, you know what? And that's pure. I think really, if I'm honest, very often, newer trade, I like talking about the sort of intermediate advanced stuff. I've been trading several decades now. That stuff excites me. But now and then I like to get fired up and say, hey, you know what? There are foundations that even an intermediate trader, even advanced, you have to go back to basics sometime and go, hey, listen, I'm veering too much off track. I need to bring it back to the basics. And so hopefully today, if you're a newer trader or an intermediate trader, or maybe you're a super advanced trader, you'll get something from this. And that's always my objective with these webinars, is to give as much value as possible, knowing that not everything is going to resonate. You're not going to be wowed by every single slide. I get that. But if you can take away one or two things each week that we do the webinars, apply them to your trading, improve your trading a little bit, a 1% improvement here, 2%, 5%, maybe a 10%, all of a sudden at the end of the quarter or the end of the year, you're a completely different trader. You're far more disciplined. You've got on point risk management. Your setups are dialed in, your playbook, all this type of stuff. That's really my objective. So today we're going to talk about the essential playbook for new traders. How we conduct these webinars, conduct sounds very strict, doesn't it? How we do these webinars is I'm going to share some stuff with you. And today, actually, there's a lot of slides, a lot to cover. I wanted to jam pack this one with as much as possible and just fire hose it at you in the hour. We may have time for Q&A. We may not. Let's just see. I want to cover all the information. By the way, if you do want to ask me a question, I'm more than happy to answer that. I've got a daily email. If you go to tradersmastermind.com, the logo is there. If you go to tradersmastermind.com, sign up for that. I send you an email out every day, trading type of stuff. If you reply to that, the guy who deals with my inbox will send that to me and I will reply back to you. As long as it's not War and Peace and you're not sharing like a year's worth of trading data and asking me to look at something, I will, not one question, absolutely more than happy to help you out with that. So any questions you've got on this, you can access me in that way by replying to the daily email. That goes to the inbox and that'll come to me. It gets forwarded to me. A guy checks it out for me. Okay, so let's look at this quote. Brett Steenbarger, who is a very, very, very well-esteemed trading psychologist. To be a good trader, you need to trade more than your P&L. You need to trade your plan and your process. And today we're going to cover this. How it will work is this. We've talked about that. Let's just get going. Okay, so if you have questions, fire them in the Q&A section and we'll try and get through to them at the end. Just very quickly, I want to remind you, ladies and gents, please, it's very, very risky trading a spread bet product or a CFD product. Hopefully you know this already, but as you are and maybe a new trader, and as this is aimed at the newer traders and something that don't do so much, but hopefully you're going to get really, really a lot of value, more value than anywhere else you go. I just want you to remember that it is a risky business. You've got a high risk of losing your money because of the margin, because you're trading with leverage. That works very, very well when you're making money. Hey, great, my money's working and really ramping up my profits. But there is the downside, right? When things don't work, it can get nasty very, very quickly. We'll touch on risk management in a moment, but it's something you should have absolutely dialed in before you even get involved in the markets. How am I going to manage risk before I even look at anything else? What am I prepared to risk in the markets? Am I okay to lose this money and accept in a way that, in the early days, that's probably going to be what happens. So just understand that it's not for everyone, this game. But if it is and you want to play and you want to get involved, then you're in the right place because I'm going to share with you stuff that I think is super, super valuable. Okay, so very quickly, I do have a couple of decades of trading experience, traded through all different types of market environments. You name it, you can just go back and see what the 20-year chart looks like, 22-year chart looks like. But even though I have that experience, extensive experience, I don't have all the answers, right? And I don't pretend to have all the answers, but I'm going to share with you ideas and thoughts that I think are effective and are going to help you. And also from running Traders Mastermind, which we started 5 years ago, I can see other traders who have progressed from maybe struggling to actually things starting to work for them and starting to find some traction and starting to get some good results. And I kind of see the guys who fall by the wayside. So I'm quite well placed from my own experience and observing others to put together stuff in a compact, concise way to help you as a trader. So that's why I kind of do these. And plus, I've been in this a long time. I still love talking about the markets. I'm looking at the markets every day. I might trade every day, but I'm definitely active in the markets. I look at the markets. I love sharing ideas, thoughts, all this type of stuff. So that's why I'm doing this. So also, please remember to do your own analysis, research, homework. As always, whether you're listening to me, whether listening to someone else, whether listening to Paul Tudor Jones, you do your own analysis, because not only is that verifying what's been said, but it's also helping you boost your confidence in that you've done the work yourself. You've kind of gone out and you've researched and you've found stuff that actually makes sense rather than just taking it from someone else. Things take time. Implement a change and stick to it. More on that later on, and you observe the results and make course corrections. And what I mean by that is be careful not to strategy hop, especially as a newer trader or developing trader. Very easy to not see any results immediately with the strategy you're deploying and then go, ooh, shiny object. That looks like an interesting strategy, and start to dive off over there. And you kind of just constantly strategy hopping. Things take time. Implement the change, stick to it. Okay, so let me just double check we're on. Yeah, we're good. Let's roll. Okay, so by the way, this is what I meant to say. These gentlemen are a must follow. Pepperstone have not asked me to plug these guys, but I follow them because of this. This is Chris Weston and Michael Brown. They are the strategists at Pepperstone. Why? It's on Twitter, X, say X, Mark, not Twitter. They're on X. Why? Because of this. Chris Weston has been updating this kind of election dashboard that he's got, showing you. I think it's going to become more and more useful as we get into the election date. I find it very, very useful. Just keep my finger on the pulse. Not yet is it moving the markets, but it will do soon. There will be these swings, and they will shift the market depending on, or shift sectors as well, and which might have an influence on the market depending on what's going on. So that's worth watching. And also, one of the main things that Chris posts actually is the week ahead. So kind of an idea, very, very simple and concise consolidation of all the stuff that's important for you as a trader. So he'll highlight things like, hey, UK GDP is worth watching, the CPI, of course, ECB decision, and some of the major earnings that might relate to the stocks you trade, or they have an impact on the underlying index that you trade. That just makes sense to follow those guys. So, like I say, I've not been asked to do this, but I follow them and I've really, really valuable. So check those guys out on X. Okay, today we're going to cover foundation trading strategies, key indicators, practical applications. Well, one really, risk management techniques, developing a disciplined trading routine and building confidence in your trades. Hopefully this is something for everyone. So let's get started. Trading strategies. This is the big thing that everyone wants to come, right? How do I trading strategy that's effective? This and that, the other. Well, listen, there's so many complicated things out there. Do this when that's that. When the sun's aligning in the sky and the RSI is down this, then go long. If the market touches this and a scorpion stings you on the toe, then go short. You know what? You see it all the time, right? And ultimately, they come down to two things. Not all, there are some other strategies, I'm aware of that, but 90% of strategies that you will deploy as a trader, as a retail trader especially, come down to two foundations. You're either trading momentum or you're trading what's called mean reversion. Now, let's define these first. So momentum, and this is honestly what I've tried to do here. Let me kind of cycle back a little bit before we get to how far ahead of myself. I've tried to really think of the simple terms that actually are the real core foundations of trading. And if you build solid foundations in trading, you can layer on things as you please, but you know that if it doesn't work, you fall back to your foundations, your base. And so there's certain things I've simplified and distilled down and said, hey, these are worth sourcing out. Don't overcomplicate things, because if you can simplify this, then if you want to add layers of complexity and go advanced strategies and add layers of kind of cross-checking and triggers and filters, then fine. But ultimately, we're trying to do this. So that's kind of where I've approached this. So going to mean reversion. So let's define momentum. So momentum is really trend type day. You might have heard of that, or maybe it's a short-term aggressive move. It's basically saying, hey, the market is going, let's say it's going up. I expect it to continue, right? That's momentum. That's one way of trading. The market's going up. I expect it to continue. I'm going to go long. The market's going down. I expect it to continue and going short. Very simple. Appreciate that. But ultimately, that is one side of the coin you can play. Okay. And all the other intricacies of how you're going to time that, you're timing pullbacks, you're buying breakouts, you're doing taking flags, you're taking fake out, you're doing all this type of stuff, then ultimately you're trading in the direction of the move, right? And the other thing you can do, I'll give you an example here. I forgot to put these on. Here you go, direction of the move, downtrend, 5-minute chart of yen, USD, JPY, little pullbacks, little bear flags, trend is lower, is momentum, the market's moving lower, tends to be, you get this kind of three pulses, then you get a larger, deeper rotation, a pullback, and then it finally goes lower, and there's a kind of breakout type thing here. I'm simplifying stuff, but hopefully this gives you an idea. We're trading short in the direction of the move in momentum. We're not looking for it to turn. We're not trying to be clever. We're just looking for that trend to continue. Okay, so the other side of the coin, and the only other thing you can really do, is fade the move, right? So if the market's heading higher, you go short in the expectation of it to come back lower. If the market's heading lower, you're going long, looking for it to come back higher. So you're doing it completely opposite. These are really the only two things you can do. Of course, there's a third thing, which is do nothing, which really should be your default setting as a trader. I do nothing. I'm not interested until I see my setup, strategy, reasons to get in the market. More on that in a moment. But you can see the two foundations sit here. Yes, there's loads of complex stuff that can come from this, but you're either trading with the trend or you're trading mean reversion. That's really the foundations where things come from. Bear with me as I kind of run through this and talk about the North Star and the hypothesis that we kind of come up with in the trading day to generate a strategy. So mean reversion is fading the move, counter trend, reversal, exhaustion. Examples you might have heard: double top, pin bar, 1, 2, 3 pattern. And if this stuff doesn't make sense to you, that's okay, because I think a lot of people jump the gun. They move to step 5 rather than just solidifying steps 1, 2, 3, 4. And if you have a good foundation, the other stuff makes much more sense. When you start to go in the intricacies of the pin bar, you start to go in the intricacies of all these patterns and stuff, they make sense because you go, That is a mean reversion. Here's my hypothesis. How does that fit in? So mean reversion, trending, or momentum, very, very it covers everything pretty much. Example here, 5-minute chart of the DAX or German 14 DAX equivalent on Pepperstone. It's just oscillating in a range, right? You got the low, you got the high. It's just ping-ponging back and forth, range-bound environment. You're waiting for the market to come up and retest the high, waiting for it to go back lower, waiting for it to test a low. That's a very different chart to this trending chart on the Japanese yen. Just have that in your mind as we move forward. There's your trending chart, momentum chart. There's your range-bound mean reversion chart. Important to note that. More on that in a moment, but let's move on. So your North Star. As a trader, we can layer in loads of complexity, right? But ultimately, no matter how complex a strategy is, a setup is, how it's all there's loads of complicated stuff out there, and some of them have got merit, okay, but most of the time the simplicity is most effective. But they all come back to these one thing. If you're trading with momentum, you believe the market is going to continue in the same direction. If the market is moving higher and you go long, you believe the market is going to continue in that direction. That's it. No matter how you come up with that idea, no matter how complicated it is, that's your foundation, that's your North Star. So, jump ahead of myself slightly, we want to make sure that the conditions are right for that hypothesis to become true. Look at mean reversion. You believe the market is going to change direction. It's a fancy way of saying I'm trading reversals. I'm trading against not necessarily against the trend, but against the initial move. The market's going up. I'm going short because I think it's going to come back down. The market's going down. I'm going long because I think it's going to come back up. That's the only two North Stars we've got. And we plant our flag in one camp and go, I believe the market's going to reverse at some point. And then we can time it with triggers and filters and adjustments and maybe indicators and stuff like that. Price action, great. But that's it. And I think many traders miss cycling back to the basics and saying, right, I'm buying this because I believe someone is going to buy this after I bought it to make the price go higher, because that's how price moves, right? If you've got buyers and sellers, there's an equal number of buyers and sellers. But if the buyer is more aggressive, they're going to pay a higher and higher and higher price because they need to get in. They've got more urgency to them than the sellers. That causes price to go higher. So if you're buying, you're believing that others are going to come in and buy after you. The aggression is going to continue for the market to go higher. That's it. That's really all the guess, the estimate is. And when trading mean reversion, you believe it's gone too far, and actually you think the opposite is going to be true. And that is really the main focus I want you to have in your mind as you move forward, is whatever the complexity, whatever you come across in trading, it comes from these two foundations, these two pillars. And cycling back to that and looking at the market through that lens will save you so much hassle, time, possibly money as well, because you're just looking at it with a very simplistic focus of, hey, why should the market go higher after I bought it? Why do I think the market is going to reverse? Okay. And so I think that many developing traders miss out on getting the right context for that hypothesis to be true. And what I mean by this is it can be complicated. It can look really, really good on paper. But if that basic assumption isn't right, it's just not going to work. Okay. So let's with that in mind, let's look at context, because this is missed, and this is honestly something that's so simple, but is such a saver of hassle, of capital preservation, of mental capital preservation, just understanding the context that you're in. And again, going back to the North Star, am I trading with the expectation of it going higher? Am I expectation for this to reverse? That's it. Okay, so what's the nemesis of that? The nemesis of both of those is a choppy, directionless market. I've not met any trader in my career, and I've seen a lot of traders, hundreds, not thousands of traders, way more than thousands of traders, some exceptional traders, some awful traders, and a lot in between. I've not met anybody who can consistently trade well in choppy markets. Okay. Now, differentiating, should I say, between choppy and range bound and mean reversion, sometimes it's not quite as clear, but this is where you train your eyes and you say, hey, this is just doing nothing. This is sitting in specifically this kind of time between 4 o'clock and 6 o'clock. This is doing nothing. It's a very, very tight range. It's one red candle, couple of green, couple of red. It's chop, it's slop, it's dirty candles, it's barbed wire, whatever you want to call it. This is the nemesis of all traders. So Your first objective is to avoid this at all costs. This is a trap. This will suck you in. This will extract money from your trading account into somebody else's without any hesitation, because it's the worst possible environment. Some people say, Mark, risk in trading is getting stopped out. Risk in trading is this. No, no, no. That's fine because you accept the risk. You place your risk. You've got good risk management. We'll talk about that in a moment. We'll touch on that in a moment. This will take money from your account more than anything. Believing that there's something here. Why? Because if we go back to the initial core foundations, there isn't anything here. There's no lens to, oh, I believe it's going to continue. Why? There's nothing there. So just avoid choppy markets. Okay, so some rules to help you avoid these choppy markets. Use your eyes. Honestly, guys, if you are a discretionary trader, you're a screen-based trader, which I know many of you are, that's the one thing that gives you the edge over anyone or anything or any computer out there. Humans have a very good ability to decipher what's on the screen in front of them and make an objective assessment. That's why many discretionary traders who are at the top of the game are outperforming a lot of the algos and a lot of the systematic stuff massively. And if you listen to the or read the Jack Schwager Market Wizards series, is definitely another series of books I recommend. He says, and one of them, I can't remember which one it was, might have been Hedge Fund Wizards. I know it doesn't matter which one it was. He's got a series. He said, hey, generally speaking, when I'm reviewing and I'm going and back and looking and auditing the performance, discretionary traders have a far better return than some of the systematic guys. Now, there's pros and cons. I'm not saying don't be that. But what I'm saying is if you are there and you're in front of the screen, use your eyes, trust your eyes, learn to develop the intuition, learn to develop all that stuff, because that's going to serve you in good stead months, years down the line. You know, it's especially if we're avoiding choppy markets. Don't be fooled by that one trade you took and won. We've all been there. We've all taken a trade and a real chop and slop, got away with it, thought, I'm a genius. I don't need to avoid choppy markets. That's the one that's going to catch you out and suck you into taking 10 more that are losers. So just recognize that, please, before we move on. Choppy markets, enemy. Just remember that. And like I said before, this has slaughtered so many traders. You get sucked into believing you see something, and especially for active traders, even if inactive, you know, for swing trader, day trader, whatever, just avoid choppy markets. Okay. So how to identify a trend or momentum? Sounds very simple. Again, let's just use our eyeballs, guys. You trust your eyes. If we're not writing algos here, if you're writing an algo, you'd have to say, well, if prices moved X amount, it's above this, and the ADX is this, and you'd have to kind of quantify it as a binary yes or no. Trust your judgment, trust your eyes, right? Large moves in one direction. You know a trend when you see it. I'm sure you're not brand new that you've not looked at markets before in charts. Bigger candles, more green than red in the case of an upside. Pauses, pullbacks, next leg. You know how it goes. You get a pause, you get a deeper pause, deeper pullback, a cycle, 3-minute cycle type thing, push back higher, intraday chart type of stuff. And the biggest mistake that traders make is trying to be smart about the trend duration. Been there, done it, made all the errors. You may have too. That's gone way too far. It's got to reverse. I'm not going to take the trade. I'm not going to buy the pullback. Maybe I'll be clever and try and be smart and take the reversal. Let the market tell you. The one thing that's so clear, and if you kind of listen to some of the old school traders, there's a great example here, this old school trader, trends will carry on way further than you think. Let the market tell you when it's run out of steam. Right? And the sooner you can become happy with that and be at peace with that, the better your results will be. You know, I'm kind of want to share this stuff is like, hey, this is the one of the things that catches traders out. If you're trading momentum, just trade the idea and setup, which we're going to cover in a moment, that's on the screen. Don't try and be smart. Don't try and overthink it. Now, sure, over time, you might find you're a little bit late in the trend and you come up with ways to get in the trend earlier, but trying to be smart and trying to say there's a trend, it's going to reverse, it's just going to kill you. It's another of those things that's going to catch you out. Okay, so my meme. Don't try and be smart, just observe. So we've seen this meme, right? You've got the guy in the middle who's like high IQ and he's like, this market's moved too much. I'm fading this thing. This indicator is telling me that. And I've got a full moon today. And, you know, the statistics show this. I'm just going to fade it and try and get this. And you've got the guy on the left who goes, listen, price is going to tell me what I need to know. And the Jedi on the right, who's price is going to tell me what I need to know. I'll let the price tell me when the trend is ending. And that's it. It's because it's gone lower and it's moving lower. Okay, the trend's ended. As simple as that. And this is really, and I'm oversimplifying. I'll show you some chart examples in a moment. But don't be the guy in the middle. So many traders have, a lot of success in other parts of their life, business, career, what have you. You're brainy, you're smart, but then trying to outsmart the market, and the market doesn't. It's not that way. The market's a game of chess, a very simple game of chess. It's not easy by any stretch of imagination, but ultimately, the more simple you can make it, this is how they get the results. And funny enough, I know guys on the left hand side of that who are like, maybe not that low IQ, but I don't know much about the markets. The market just goes up and I wait for it to go up strong and I buy it. I jump on the trend, I jump off. Who are doing very, very well. And the other side, there are super intelligent guys who say, listen, I'm not trying to outsmart this thing. I'm just trying to go with the market because I believe that is the source of truth. And the guy in the middle is there trying to, I'm going to do this, I'm going to do that. And there are most of the time the guys who struggle with this type of thing. Okay. So example here. Look at this 4-hour chart of NASDAQ. Distance between there and there, 9.4%. This was the other day. Remember this August sell-off we had? Big move, right? Over a really big move, actually, over a couple of weeks, but quite big, deep move. And there's people saying that's the end of the trend. It's going to go. That's the end. And it went another 12% from there. It went from 19,600 down to 17,200. Not many people expected that. And I'm not saying, hey, this is a setup and pattern you should look for. But my idea of sharing the slide with you is to say, hey, look, trends always go way more than you think they do. The rational mind can't compute it. So don't try and be smart. We can come up with stuff in a moment, how do we spot these reversals, but I just wanted to make sure that we're clear that we don't try and be clever with things like this. Okay. So how do we identify mean reversion? Let's flip the coin, go on the other side of the table for now. Don't try and fade trends. That's not what we're doing with mean reversion. Mean reversion, we're trying to find the conditions that match the strategy we're deploying. Remember, mean reversion is going the opposite way. We're not looking to fade stuff. We're looking to go back and find markets that are doing, where is it? This is, and we see this, we go, I'm in mean reversion mode now. And that's simple enough, but many traders don't do it. We're in trend mode now. So get in the mode based on, or shift yourself into the mode that the chart is telling you rather than trying to be smart. Okay, so how to identify mean reversion? Don't try and fade trends. You're in trend trading mode there, or you're not trading at all. Look for markets that have that wide range, not chopping around like that DAX example, just the nice rotational markets, testing highs, testing lows, no real trend, but buyers are coming in, sellers are coming in, buyers are coming in, sellers are coming in. I'm oversimplifying it. I get that. I understand that. But that's really, then we go, okay, now I'm going to trade mean reversion. I'm going to be like that guy on the right, the Jedi on the right of that meme. I'm not going to overthink things. I'm going to draw my level of support, my resistance, wait for price to reach that level, wait for price to come away from that level, take the trade. I ain't going to overthink it or try and be smart. Now, will this serve you forever and ever? Yes. Are you going to have to do more than this? Yes. You're going to have to layer in more stuff into your trading than just this simplistic version, but it's a great place to start because it means you're not undoing all the months or years of bad habits by overcomplicating stuff. You just train yourself to spot the conditions. Chop and slop, not interested. Training environment, I'm buying pullbacks or flags. Mean reversion rotation environment, I'm selling highs and buying lows. Now, where you do that and how you do that is where the complexity comes into it. But going back to those initial slides, that's all we're doing. And if we can just focus on the chart and go, that looks like a good mean reversion chart, I'm going to trade stuff. Example here, our chart, S&P 500, Pepperstone's US 500 is the equivalent. Highs, lows, highs, lows, highs, lows, eventually breaks, you stopped out. Now, I know I'm oversimplifying this and I'm not suggesting you can just go in there and that's it. But if that can be your North Star and you look at that chart and you go, hey, on this time frame, I'm mean reversion. I'm not trying to be clever. I'm not trying to be smart. I'm just trading mean reversion. And if the chart is going from left to right, bottom left to top right, you don't say I'm trading mean reversion. I say I'm looking for a trend. I'm looking to follow the trend and let the market tell me that things have changed, like breaking out down here. Okay, so momentum strategies. If you're going to trade momentum, so you're in the trend, focus for me and the way that I would approach it, and obviously you approach it as you wish, but I would focus on just buying pullbacks and flags. Don't play breakouts for now. Why? A lot of new traders kind of try these breakouts, and fine. Opening range breakout, I think it's a good strategy. There are some afternoon breakout, fairly good strategy, but it can be frustrating for newer traders or developing traders because of the fake out scenario, because the conditions have to be so good and the context has to be spot on to trade the break. So if you're going to trade a trending market and a momentum strategy, and you're going to focus your energy somewhere, right? You're going to got finite resources, whether that's focus, mental capital, financial capital, then focusing on buying pullbacks and flags, I think, is a better allocation of your resources than trading breakouts. Personal preference, again, I don't have all the answers, but I think if that's what you're focusing on, get good at finding trends, waiting for price to stall, stagnate, pull back, look for the flags, and get very good at that. Trading is about becoming an expert in one or two things. If you try and master everything, you master none, because the bar is so, so high. Our competition is so, so high. We are competing against the brightest minds in the world, the most well-capitalized companies in the world, computing power, AI now, top traders at their game who have been trading decades and decades and decades and are well-capitalized. You've got to be on point. You've got to be a specialist. You've got to be very, very good at something. It's impossible to be good at everything. Absolutely impossible. You can do one thing, but you can't do everything. Very, very good quote for trading. Okay, so example, 1 minute chart of the SPY or S&P 500, should I say? Look, it's a trend environment. There's nothing, you can see it yourself. It's a trend. Let's not overcomplicate stuff. Don't say, well, it could reverse here. It could. No, it's a trend. Simple as that. When it reverses, you'll know. Okay, so one thing you looking for would be, okay, I'm going to take flags. I'm going to take pullbacks to the 20-period moving average. I'm going to take flags under key levels like overnight low. You see, we're adding a little bit of complexity in here, but not much. We're trading in the direction of the trend, waiting for a pullback or a flag. Are they all going to work? No. That's where risk management comes in, but it stops us trying to be smart. Like, oh, I'm going to do this. I think I'm going to buy here because it's support level. It's not a mean reversion environment. Yeah, fine. Sometimes it's going to bounce off that and go straight higher, but let the market be sitting there ping-ponging back and forth using that as support and then go, we're in a mean reversion environment. Now I'll buy it. Align your trading to the environment you're in. Honestly, that's the one thing I think is missing from many, many traders. And it's such that simple foundation and wanting to overcomplicate stuff. Okay, so mean reversion, let's look at examples here. Focus on those reversal patterns, support or resistance fake outs. And I would not trade exhaustion for now. Last week, I think, was it last week? Or the week before, I talked about exhaustion. And I love exhaustion. Don't get me wrong, one of my favorite patterns. I love, love, love trading some type of exhaustion. Talked about extension of the bar, the volume of the bar, all this stuff. But that's advanced things that really you don't need, right? If you're trading mean reversion, you say, right, I'm going to look for reversal patterns. I'm going to look for support and resistance fake outs. What do I mean by that? So I mean that when you've drawn a low, market comes down, it breaks through a low, and you decide to take the trade. Now you could argue, oh, Mark, it's a trending environment, it's this, that, the other, and yeah, maybe I could give you that one, but as we pull back up here, we kind of transition from a trending to almost a mean reversion. This is what's called a double bottom. So to go back to simplistic kind of definitions, if you like, draw your support, draw resistance, and just focus on that. So trending, just focus on your pullbacks, your flags. Mean reversion, just focus on support and resistance fake outs. Reversal patterns, they tend to come with it. So a double bottom is a reversal pattern, but it tends to come with the fake out, the pin bar, the probe, the flush, the Wyckoff spring. If you want to go and explore Wyckoff, I did a webinar all about Wyckoff. That's his type of thing. Test the low, can't, sellers look down there, and then tends to rip back up with a lot of strength. Aussie yen, same type of thing. Let's not be smart about this. This is a 5-minute chart and it's an absolute range. No trend here. Okay, if you're going on a kind of micro 1 second chart, yeah, but the time frame we're trading is in mean reversion. So what do? We look for penetration through support, through resistance to fade. This is a perfect one. Through support, faked, came back up, ripped to highs. And you could even arguably take that there, whipped through, came back, and then that was down there. That was through that prior high. So not being clever. And again, I'm not kind of giving you a really detailed strategy filter and trigger thing. I'm just saying, hey, listen, this is if you simplify it, it'll do most of the legwork for you. And then another example here, choppy, not necessarily choppy. I think this is more like a mean reversion environment. Decent enough ranges to warrant getting involved in it. Just about. Example of dipping through support and popping back up. Okay, so let's keep moving. I know we're moving quick, but I've got a lot of stuff to cover. Hopefully that makes sense. Q&A is there for you, ladies and gents. If you something doesn't make sense, you just want to clarify something, I'll definitely try my very, very best to get to that. Okay, so we talked about the trends. We talked about mean reversion, talked about simplifying your approach and really putting context in place, trusting your eyes. Is it choppy? Don't trade it. Is it oscillating around, just like those examples? Okay, mean reversion mode. Okay, next step, my support, my resistance, fine. Buying through support wicks, selling through resistance, tails, all the way around. Trending. Is it trending? Eyeball, yes. Pullbacks, yes. Flags, yes. Trading reversals, no. You get the idea. Simplifying your process, becoming a specialist, and even going to the point where you do one or the other. You trade momentum or you trade mean reversion, but more on that in a bit. Okay, so I've basically just covered this slide. I guess your trading process, you look for those trends, you plan them, you wait for the pullback, you wait for you find the rotational market, you plan, you wait for the level. Leave alone. Trust your eyes to spot the differences. And this is something you can do right now from moving on for the rest of the week and for the rest of the month. Just look at the market and go, that's a trending environment. That's mean reversion. That's choppy. Most will sit in the chop where you go, oh, it's a bit in between, almost a bit ambiguous. You don't need to trade it. The beautiful thing about being a retail trader and most of the thing they're trading from home with your own money is that you can say, I ain't trading that. Why am I going to risk my hard-earned capital on something I don't really know what type of market it is? Wait for the proper trend to come and say, right, that's a trend. Now, I'm not going to be clever and try and find the reversal. I'm going to wait for a pullback. I'm going to wait for a flag and define what you're looking for. Or you have a nice rotational market. It's rotating back and forth between key levels. You say, hey, there's my key level. If it gets hit, I'm going to fade it. If it doesn't, then fine. I've got my stop loss, which we'll talk about in a moment. But it's simplifying stuff, honestly. Okay, so become a chart review wizard. I've added this, maybe it's a little bit of extra complexity, but I kind of want to show this not as simple as this, but if you have the simple stuff, the other stuff becomes a little bit easier. When you're reviewing your chart and you're marking up your chart, look at the time of day that things happened. Okay, that's a really key bit of I never give advice, but something that helps me loads is looking at the time of day that movements happen. When do lows occur? When do highs occur? When does momentum occur? When do trends tend to continue and get another leg in? What's the direction of the trend? What's the higher time frame chart looking like? So if you're trading on a 5 minute and you see it oscillating around key levels, what does a daily chart look like? Are you in congestion on a daily or are you in a monster uptrend? And just making notes on this type of stuff. How long has the trend lasted for? Any news flow? And this might not make sense to you kind of as depending on where you are in your trading journey, right? But just starting to observe this will pay dividends later. You just about getting familiar with different situations. We're chopping around. We've been chopping around all day, but we're in the context of a really strong uptrend on the daily. And you know what? We're really ripping off those lows intraday, but actually it's just a bit of it looks like a dead cat bounce type scenario on a really, really bearish daily chart. You get the idea. And so one thing to do that I really suggest that a lot of traders do is print off the charts for the markets that interest you, right? So, yep, old school, print off, get a printer, print it off, turn your screens off, sit there with a pen and paper, pen and the printed chart, and just go through the chart, make observations. Just make little notes. Just say, I think this is mean reversion. We touched this level. We didn't do this. What time of day was that? Okay. And that, honestly, something about that process just unlocks a different level of perspective. And you look at the market through a different lens than you are if you're sitting here staring at the screen going, the bloody candles, this and that and the other. So I really think that's a very good process to do. It doesn't take very long. And the beautiful thing about this is it takes you away from the screens, right? You print up the charts for the day or charts that interest you. If you're not trading, you just want to learn. You say, I'm going to do this currency pair. I'm going to do this index. I'm going to do this commodity, this stock, whatever it is. Print them off. And then you can go and you can do it on a dining table, you do the kitchen. It doesn't require that much mental load. And you're just observing. And you're letting that observation process get better and better and better over time. Now, One trap to be aware of. Actually, I think I've done a whole webinar just on this process. If you go on the website, you go on tradersmastermind.com, scroll through the webinars I've done. I'm sure I've done something where detailing this in sort of really, really fine tune this process. Don't hindsight anything. What I mean by that is don't say, oh, I would have bought the low there. I would have sold at the high. Just be honest and look and right. You're not trying to say anything massively where you would have taken a trade. You're just writing observations. There's a subtle difference, right? And the subtle difference is, hey, I'm looking at this through the lens of where would I have traded versus I'm learning, I'm observing, but I'm doing it in a peaceful, calm environment and saying, hey, look, this is definitely a mean reversion environment. What time of day is this? And just observing. Then after that, by all means, you can look at it and say, well, how can that apply to my trading? Do I need to filter my trades within a specific window of time? Do I need to wait for this type of candle off the high or low? That type of thing. Okay, so let's move on to simple risk rules. And I appreciate I'm moving fast, but again, if you want to ask me questions, you absolutely can. I'm pretty sure Pepperstone will send the recording out as well if there's something you missed. Simple risk rules, use stop losses. I'm a big advocate of saying, listen, just simplify stuff. Later on, as with the entries and all this type of things, we can get more complex, right? That is always there, and often we go down rabbit holes of super complexity only to go, this makes no sense. It's too complicated. So something that I think is effective when you're learning trading to a certain extent or developing as a trader, improving, is to simplify things. And one analogy I give is, many of you have heard of this before, is you've got a dashboard in front of you, right? You've got these different buttons, knobs, dials, levers, and if you get the right combination, that unlocks decent trading. Okay, it unlocks good trading. And very often they're labeled stop loss, they're labeled running trades, they're labeled position size, they're labeled setup, they're labeled strategy, they're labeled context, they're labeling. And the trouble is, if you're there adjusting all these dials, you'd never ever find what the formula is. You never ever crack the code, so to speak, because you're constantly tweaking, adjusting. You don't know what's affected what. So the very simple way to do it is to have a control and say, right, my stop loss is staying the same regardless. I will look at that dial later, but I'm not going to move that. I'm going to look at context only and find that, ding, it's working for me. Now let's layer in my triggers and my actual setups. Ding. Okay, now I'm going to fine tune my stop losses and get a bit better about the risk management and maybe not risking so much or whatever it may be. Ding. All of a sudden you find something that's effective. So simple risk rules I think are very useful is to obviously use stop losses, please. Later on, you can consider different ways to manage risk, fine, but start off with a multiple of ATR. So ATR is average true range. Where are we? I've gone way too far, haven't I? Here we go. I don't know why it's got 1,000 slides ahead. Simple risk rules. So ATR. So very, very simple way to manage risk is to use a function of ATR. So ATR is average true range, or you can use ADR, which is average daily range. And I've done a whole webinar on this. This is why I kind of distilled this stuff into a couple of slides. But you want to go deep on that, then I recommend it because ATR is very, very powerful. It basically tells you the volatility of the instrument, right? So what you can do is you can put it on your chart and say, give me a 10-day ATR or ADR. They are similar if you're looking at charts that don't have gaps in, and say, right, I'm going to use 25% of that or whatever number you want to see fit. So that way you have a fixed stop. It's quite wide. I'm talking about day trading here, by the way. If you're swing trading, you might do a 10-week ATR on a weekly chart and adjust it from there. But you want to use a fixed stop that's wide enough to not get pinged out on noise, right? And that's going to be wider than the optimal. I get it. I understand that. And you will want to adjust it at some point. But for the initial progress, the best course of action, I believe, is to have a fixed, reasonably wide stop, not crazy stop, and not having to second guess it and trying to go, oh, you know what? I'm going to put it under this key level. I'm going to put it behind this ignition bar. That comes later, and you will want to do that later. There's no doubt, because that's how you optimize your performance, is by saying, hey, how can I increase my risk reward ratio on the trade? Well, I can risk less, but you don't want to have it too tight that you get pinged out on noise, and too wide, the risk reward and the structure of the trade becomes not worth it. That's something you can look at later. So if you just take a fixed risk and say, hey, If you're a new trader, you want to risk £25 on a trade. And by the way, don't worry about trading small. Make that £2.50 if you want. You don't have to be risking thousands and thousands on a trade or hundreds on a trade when you're learning and you're improving. In fact, I absolutely suggest you do not. You risk a small amount, something you can afford to lose, something that's very, very, very meaningless to you so that you can get used to trading. So say you want to risk £25 on a trade, right? You're a brand new trader or you're a developing trader and you or £10, whatever it is, but let's do 25 this example. The ATR is running at 250. So you look at the 10-day ATR, very simple to do. I'll show you in a second chart example. You say, right, and on my ATR, my stop loss is 250, should I say? And you've done your calculation. Hey, do you know what? My trade size needs to be 10 pence a point or equivalent CFD. You just work back, and this is simple stuff, and hopefully you know this already, but this is how you allow for noise without overcomplicating the issue of stops. Because another trap that a lot of traders fall into is they try to overcomplicate the issue of stops and fine tune the stop. And what happens is this, and I've seen it so many times before with traders. They have a good strategy, they're effective, good context, good, all the stuff is in there. And then they try and tighten the stop up, and the stop game is poor. And that can ruin the whole edge. If you're there trying to have finesse the stops, you're trying to do this and trying to do that, you might have a great strategy, a great setup, a great trade, but you're getting pinged out a little bit of noise. You'll never find out that's a great trade. So be very, very simple. And I know it's tempting to use tight stops to begin with, because the logic is tight stops, less risk. Hey, Mark, why do I want to risk 250 points on this? I could risk 25 points. I could increase my size by 10. That sounds better, because if it goes in my favor, I'm going to make 10 times as much money. Well, yes, but your logic is flawed, because the trade's got to go in your favor in the first place for that to happen. And so this is a really good way of structuring your risk, I believe, without kind of overcomplicating stuff. And you can complicate things later if you like to. So example, let's run through example. Got a daily chart of the DAX here. Your 10-day ADR or ATR, same thing basically when you have no gaps. The ATR just takes into account gaps more for stocks. You'll get a similar reading. What you're using, TradingView, just look at ADR. Any platform has got ATR or not all have got ADR, but ATR is fine. 10-day, I use 10, you can use 14, default's 14, I think most of the time. It's running at 210 points, right? So that's the average daily range of the DAX over a 10-day period, or the Pepperstone's DAX equivalent. So take a quarter of that, 52.5 points, there's my intraday stop. So now when I'm trading intraday, I just simply know that I use a 52-point stop. And so if I'm buying the breakout here, there's my stop. Now, it might seem wide, but that's the point, because you want to eliminate that as a friction and a breaking point in your setup and your plan development. You can review this later, and there'll be some setups that you want a tighter stop, some setups you want a wider stop, some setups you want to avoid because the stop doesn't make sense. But when you're developing, take the stop off the table and say, right, now I go back and review. And that's a really simple way to do things. Okay, so moving on to data gathering. So what I mean by this is, listen, we're not moving on. This is kind of goes hand in hand with this. If you're trading small with wider stops, you gather data on your performance and then you review and adjust. And so like I said at the very, very beginning, the second slide or whatever it was, this is how to develop as a trader rather than going from, I want to go from point A to point Z, just like that. You go, hey, I'm going to play a long game here. It's going to take me some time. My performance is going to be pretty crap in the beginning, but that's okay if I trade small with wider stops. Maybe on paper it doesn't look so good, but I'm gaining experience. I'm getting screen time. I'm gathering data on my performance, what I'm good at, what I'm not so good at, so that I can make the course corrections and adjustments based on what I've done. So you trade small for a bit with those wider stops. You look and you go, all right, I lost money, but that's okay because I traded small. But let me look. What were the good trades there? Could I have done that better? Or actually, next time, if I wait for that candle to close or I wait for that level to be retested, that looks like it's going to serve me in the future. So you make a little adjustment on your plan. You go, hey, actually, on this trade, I don't need a really wide stop because these are the trades that go my favor straight away, the good ones. So I'm going to use a tighter stop. Goes in your plan, and then you move on and you trade that for a while. And you gather more data and you see how you can iterate and improve. And that small incremental improvement helps you get to the end destination rather than just trying to jump to it. I want to get it right. Oh, and it didn't work. I want to get it right. It didn't work. And then you get frustrated. You start trading more size. You start losing money, and you get into a real mess. Okay, very briefly, you mentioned indicators. So ATR, ADR, I think is essential for stock placement. If you must use a moving average, fine, to help visualize trends. I'm a big fan of going naked first. So trading naked, nothing on your screen apart from your ADR calculation, just so you can see price. So you can visualize what's going on. You can see what's going on. You can use your eyeball. Now, if you want to use a moving average, and that's fine. Don't clutter it up with 50 different moving averages. Just stick one on. Stick a 10 on. Stick a 20. Five's a little bit tight for my liking. It's okay for certain setups, but something relatively like that, so you can just see it and adjust it and say, hey, this is what trends look like. It's what choppy markets look like. This is what mean reversion looks like. And I look at it relative to a moving average. Okay, one word of warning here is and again, it's just my opinion on stuff. You find your own path and go down your own rabbit hole. Sometimes we have to make our own errors, and maybe you find a breakthrough and stuff. But honestly, I see this, and again, I'm kind of sharing this from a perspective I think is reasonably valuable of my own experience, a couple of decades, and seeing very many other traders how they've performed, and the ones who have gone from struggling to actually a couple of green years, that type of thing. The ones that do that, they say, listen, I'm not going to put another indicator on. That might look good. That might be tempting. I might get seduced by the fact that that's going to show me this. But the way I think to do it is to say, hey, develop your own style. If you're trading trends and you say, I'm looking for pullbacks and flags, and you say, actually, you know what? I might use a stochastic to help me because of my previous trades. I've looked and you've done all the data, you've done all the small trades with the wide stops, and you said, I'm a little bit early on those pullbacks. The trend is going in my favor, but I'm a bit early, I'm getting stopped. How can I manage that? You know what I'll do? I'll use a stochastic or an RSI or a CCI or another oscillator, and I will buy the first oversold in the uptrend. That is then using an indicator to help guide you for something you've already observed. That's the opposite to what most traders do, which is stick the indicator on, then look for a setup. I believe that that is the wrong way to approach it. The correct way, I think, is to observe the trade, observe the price action, observe the setup, and then say, hey, how can I use an indicator as a filter to help me make better trades in this strategy bucket? So that example, that pullback, I'm a little bit early, but if I use stochastic, the right settings, as soon as it's oversold, now I'm allowed to look for the reversal. It just stops me going a little bit early. You get the idea. Maybe you're trading a trend, use ADX, whatever. So use the indicator to match up with the strategy you're trying to deploy, not the other way around. I think that's a trap. I see a lot of traders fall into that. They've got a very pretty chart. There's a lot of colored lines on it. It looks very sexy, but it doesn't help them out. And that's not what you want. Okay, so trading psychology. I've crammed a lot into this slide here. And this is a 50 webinar series on its own. I've touched on this topic before. And again, one of the reasons for doing this is if something resonates with you, you want to explore more, there's more content that I've done, and I've got lots more coming over the next couple of months that will support your trading and hopefully help you. But a few things here, maybe I won't read all of them, but don't worry about the outcome of each trade. It doesn't matter. You're here for the long haul. The traders who struggle are the ones who are so focused on the outcome of that trade. If you read some of the psychology books, Trading the Zone, even Best Loser Wins to a certain extent, Tom Hugard, all say the same thing. Even Jesse Livermore, the old raggedy copy here. Don't worry about the outcome of the trade. Trade for a couple of weeks and then don't change anything, and then audit. So I talked about that. Gather the data, then audit and adjust. Make the course correction again. Make the course correction again. If you try and make massive changes, you don't know what's worked. You'll feel like the biggest fool alive. It happens. You're going to buy the high. You're going to sell the low. You're going to miss it by a tick. Everything you do will be wrong. Welcome to the game. We've all felt like that, and you will feel like that again at some point. You got to shrug your shoulders and say, hey, it's my learning experience. You're going to make mistakes. That's fine. Just make sure that the risk is where you don't make the mistake. Don't go over your allocated daily risk, trade risk, drawdown risk. We can get caught up in Mr. Perfect or Mrs. Perfect. You're never going to be. That's okay. You look at some of the biggest traders, the best so successful hedge fund managers out there or intraday traders out there. They make mistakes all the time, right? And they're okay with it. They recover from it. So, the other thing here is to create a set of actions that make you feel good about your trading. What I mean by this is your checklist, routines, and journaling that helps you to boost the confidence even when your P&L is not where you want it to be, and accept it's okay. It's like, hey, these are my standards as a trader. I do my routine, I do my checklist, I journal correctly. I'm doing the right things. That's going to help boost confidence. And when you're trading as well, one of the things that's really key, again, a whole kind of worms here, but it's building a discipline, right? Train it, build the discipline. It's a muscle that must be as strong as you possibly can, because you'll have the emotive reason to take the trade. Maybe you've done that. Trade's gone your way. Sorry, trade stopped you out, then gone your way, and you've gone, oh, I'm just going to get back in on that. I'm going to revenge trade, or oh, it's going without me. I'm going to trade that. All these things we talk about: FOMO, revenge trading, confidence issues, not running trades. A lot of this is discipline, sticking to your plan. It's a muscle. You must train it, and it's going to be tested and tested and tested. And I promise you one thing is that having really strong discipline is something that is going to serve you for your rest of your trading career, and actually it will help you outside of trading as well. And if you get attacked by road rage or all this type of stuff, it's going to help you. So it's a good point to remind you. I've got a discipline tracker I had built. It's a Google Sheet. It's a template you can download for free. Go to tradersmastermind.com. Somewhere on the top there, you'll find it. Thousands of people have downloaded this, and I'm not going to go through how you use it. There's a little video that shows you how to use it, but that will help you build discipline. I don't think there's anything else out there that helps you do this as simply and easily as this. And it's a Google Sheet. Like I said, it helps you build discipline, free of charge. Take it, use it, watch the video, and if you use this, you will improve your discipline, which is a real needle mover. Confidence. You can't build confidence until you've got performance. You don't have the performance, so you have no confidence. Is that chicken and egg? Right? We talked about this many times. So stamp confidence, or get your confidence from your work ethic and your process rather than your P&L. Later down the line, the P&L matters, right? But don't attach your value as a trader, as a man, as a woman to your P&L. It's so easy to be so disheartened because your P&L is not where it is. But think about this. If you're learning to fly a 747, right? Would you be upset if you couldn't land the thing after 3 hours of training? No, you wouldn't. Many years ago, I did my private pilot's license, and you go out there, you're like, what the heck? I've got to make a radio call. I've got to check this. I've got to adjust this dial. I've got to do my checks. I've got to then take off. I've got to watch out for this. I've got to, I can't do any of this. But of course, why would you expect to? And just like a trader, you don't expect, we expect it. Like, I'm going to go straight away and I'm going to go kill it. It's going to be taking money out of the market like this. Just recognize there's going to be a learning curve and be okay with that. And if you just use that pirate, no, that's not trained to be a pilot analogy. You know that there's an end to it, but you're going to layer on levels of skill. My radio calls, my takeoffs, my landings, my ability to navigate, my ability to deal with bad weather conditions, my ability to deal with emergencies. You stack it, you stack it, you stack it. My stop losses, my entries, my strategy, my context, my risk management. You stack and stack and stack, and maybe you get stuck on one for a while. You keep slamming that plane into the ground, land. Oh God, the instructor's like, mate, we're going to have a new nose wheel. You keep slamming it down. Take it easy. You need to do this. Learn to flare a little bit better. Learn to back off the throttle. And then you learn and you do it again. You do it again. You do it again. You improve. And then once you've got it, you can land. You land well. Same with trading. I didn't pull the trigger on that. And rather than beating yourself up and saying, oh God, I should have pulled the trigger. It's like, okay, accept the fact you're going to make mistakes, but do it again and learn to just work on that one thing, like it's for discipline or pulling the trigger or whatever it is, until you get to the next level. Then you work on the next. Just like any skill that's worth doing, it's that focus on one thing at a time. For some reason, we come into trading, we go, oh, you know what? I'm going to be a kind of commercial pilot just from opening the account and getting going. It takes time. Some people it takes a lot of time. Some people it takes less, but just have a path laid out from going from point A to point B to point C, just as if you were flying a plane, whatever it is. That's how things work. Okay, take it easy, be reasonable with yourself. It's a tough business. Give yourself time. Honestly, just give yourself time. Be relaxed. You're driven, ambitious. That's why it attracts that type of person for trading. I get it. You want to push yourself forward. You want to, show that you can do this, but it does take some time. You have to retrain the way you think, retrain the way your mind works, retrain the way that you perceive risk. There's many things that need retraining as a trader, from kind of civilian life, if you like, It just takes some time. So just stay in the game, keep your mental capital there, keep your financial capital. And if you can preserve that and stay in the game long enough, then things start to happen. Okay. Maybe there's time for a couple of questions, ladies and gents. And I recognize I have just whistled through that and I've not done too bad because we've got 5 minutes left. So I can probably answer a few questions. Oh, I take a breath after that. And should I have done less slides and two-parter? Maybe I should. I don't know. Hopefully you liked it. All right. What we got? We've got a few minutes. Let me move you over here under the camera. A few people are ask some questions. So let's get rolling. Okay, Rowie says, I wish one day we'll meet in person. Well, thank you for the progress you helped me go through. Not where I want yet, but really close so I can help my family. Oh, thank you, Rowie. I really appreciate that. To be fair to you, pal, you're always on the webinars. You're always asking questions. And that's the separator. Someone who's putting the work in and saying, hey, and fine, if you don't like this, there's people who watch this webinar and thought, I don't like this guy, I'm not going to listen to him. And that's okay. Not for everybody. But if you do like what I say and you do like, there's some value here, then soak up as much as you think you can. I've got loads of stuff that I can share with you and help you with, and then go and deploy it. And then you kind of bit more and deploy it. A lot of people kind of all over the place. Anyway, one question. I've got a strategy I focus on. You can call it a few names: break, retest, wick test, test block, etc. Whilst reading the tape, thanks to you. But once I try to define it with filters and situations, I'm confused because you have it as first pullback after low hit, high break and wick test, or anything different situation, but same kind of setup. It's confusing how to define the strategy, especially when I want to log my trades. Okay, so I've skipped through that so that I don't think people can see this, but basically what's being asked here from Rowie is he's trying to define it in Trading Plan Pro, which is the software tool which allows you to plug in the strategy into your trading plan, etc. But he's confused because has very different subsections of a broad strategy. So he's got first pullback after a low hit, high break and wick test. So Rowie, I think what you can do is just say, right, you make a decision. Do I have a bucket that I just call it's a break retest? And then there's little nuances that I take notes on, or do I call it different strategies? I think you can get so caught up in being overcomplicated and having, multiple different strategy setups when really maybe there's three buckets there. Maybe it's like, okay, one's after a little fake out to the downside, one's after momentum, one's after whatever it might be. And you just simplify it and you go, it's got to go in one bucket. My notes will kind of suggest some of the nuances that make this different to others because no setup's ever going to be the same. But if I create these kind of simplified buckets, then I've got a way of logging it. Because really the way of logging it is just to go back and review and say, how well does that setup work? And actually, if the setup works well, you dig in a little bit more and go, there's a nuance here that needs to be adjusted. That makes sense. Andrew says, will you share your slides if you may? Andrew, the recording should be up. But if you want to email, don't bother Pepperstone with it. If you email support@tradersmastermind.com, all one word, or even better, reply to the daily email, that'll probably get to me. I will get Armin, my guy, to download the slides as a PDF and send you those. More than happy to do that. Help you out there, pal. Hill Smith says, I have a question, please. I'm actually a beginner, and I would like to ask, how do I use Pepperstone to trade without high risk of losing? Here's what you do. You may understand what you're trading first, and understand leverage, and understand all this other stuff, and understand the product you're trading. Trade on a demo. If you're brand new, just get used to what the tickets do and how price moves and how your P&L moves with different size. And then trade super small, right? Just put in a very small amount and accept that you could lose that. Okay. And then trade, learn, improve, get better at trading. And then as you start to improve, you might say, okay, I'm prepared to risk a little bit more. But what you don't do is put in all the money or a lot of money straight away. So demo, then very, when you understand what you're trading and you're fine, you're happy with it, a very small amount, just get some skin in the game just to feel that pressure a little bit, whether it's £1, £2 per trade, something like that. And then as you start to develop and build your strategy, you've gone through the learning curve and it's not cost you much. Because yeah, you will draw down. Yeah, you probably lost some of that money, but actually rather than risking and losing 10 grand you've put in, you've lost 1,000 or you've lost less than that, whatever it might be. So you can adjust the amount of risk you're taking, financial risk you're taking, by the size of your positions. Okay. Now, if you're asking me, how do I trade without high risk of losing on any order of magnitude? That goes with the territory. The vehicle we're trading is a it's a leveraged instrument. Especially with trading Pepperstone, you're trading a CFD or a spread bet product. Loads of advantages with that. It allows us to kind of leverage up, and when we're right, we're going to make some good money. But the downside is that, and unfortunately, as a new trader, you kind of have more reliant with that downside, which is why if you trade very, very small, get your strategy dialed in, get your setups, your plan, put that all together, and then as you start to see results and things start working, you can kind of risk a little bit more. So just be cautious about that. And more, I'm trying to think of more stuff that might help you. Start with my daily email. There's some stuff in there that will help you if you like trading. But for new traders, I'm trying to think of a really brand new. Honestly, there you go. It's just looking at the markets through the lens of I just want to learn and improve. And if you can do that, and you say I'm just going to try and trade trends, I'm going to try trade mean reversion. I'm not going to get sucked into a specific style and just observe. You'll find that you kind of fit the style and strategy to suit you. Kyle says, what's the best way to manage trades and take trades while working and not being able to look at the charts? Okay, you've got two things, Kyle, because I think most people are in this situation who are kind of developing traders as such. The best way is to either set alerts on your chart so that you can, if you're able to come and look at the chart, but you can't stay there looking and say you're doing something else, but you're able to come, then alert will do that. Set your alert before the level so that it gives you time to come, get to the chart, look at the chart, and then decide to take the trade. The other way, which is probably what more you're saying, is to use pending orders, use limit orders, and you kind of do your analysis before the day, set your limit, set your stop in, set your target, and walk away. Now, that might not be optimal, but that's going to give you some experience and going to help you kind of, at least get some trades under your belt. It's going to do this. So it's two options. Either you set alerts that help you go to the charts when something interesting is happening, or you set pending orders and limit orders and stop loss orders, have those layered in your platform so that it actually sits there when you're not trading, you haven't got your screens on, or you're not able to be at the screens, and there's a trade there. So you might structure a simple trade that says, I'm going to buy at this support level that I've looked at over before I went to work or whatever it is. My stop loss is going to be set at 25% of the ATR. My target is going to be the full ATR. I'm just going to set that in. I'm going to see what happens. Is it optimal? Maybe not, but it kind of allows you to improve from there. That's pretty much it. All right, guys. Thanks so much. And the Nasdaq is at fresh eyes just as we finish this. So appreciate you coming. Appreciate you asking, should I say, questions, and hopefully that's helped you somehow. Take care, ladies and gents. Keep your risk managed, please. And I'm back again next week with a new webinar with Pepperstone. Take care. Bye bye.